Welcome back, traders. Got another ICT lecture today. This one is called the ICT Gauntlet and NASDAQ AM session review for May 7th. Not sure what he means by ICT Gauntlet, but I'm just going to go ahead and jump into this one right away.
Here's the NASDAQ daily chart for June delivery. And I mentioned that we were to be following the levels in this Thursday's premium wick. So it's high, upper quadrant, medium quadrant level, lower quadrant, and the open of the candlestick, which is the full range of 5 levels that make up that wick. And we were to carry them forward in the future. And let's add some lipstick on here and zoom in a little bit. So here's those levels. Here is the plasma bell sell side efficiency. We saw price drop down into on Tuesday. Monday's trading, non-farm payroll Friday. And this is the draw I think we're looking at until proven otherwise. And how will that negated? Well, we would have to trade below on a closing basis below this bullish fair value gap that's in yellow. So take a moment to look at the levels here, see the prices. And then this yellow line is that gap here. And we'll work towards going into lower time frames now. So here's a 1 minute chart. And right away, you should already recognize what this is. This is a market maker sell model. So relative equal lows down in here. Market trades higher, 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 and breaks aggressively lower. Shift in market structure here. Trades up, distribution, second stage redistribution, which is going to be the most powerful leg of the move, and drops lower. Now also, notice that second stage redistribution of the market maker sell model, not Wyckoff. The high of Thursday's wick on the daily chart, that's this blue line here. This is the upper quadrant, and this is the consequent encroachment of that Thursday daily premium wick. We're going to zoom in here and show you the details on this price slide down in to first presented fair value gap on Monday. So here's second stage redistribution and shorting. I actually have this on a video on X, so you can look at that and watch the executions and all the pertinence there. And then later on, I'll show you this here as well. So these are recorded. You can see them on my X account and the executions and whatnot. Trading down into and through the first presented fair value gap and allowing for what? The market maker sell model, relative equal low sell side liquidity. Price uses the Monday first presented fair value gap of the week, which gyrates around in there. Again, for navigation, this is Thursday's wick high, Thursday's wick upper quadrant, and half of the wick, that red line here. They will stay constant in the slides. There's pools of liquidity, and the one you always look for every single day is the range between 7 o'clock in the morning Eastern time, which is what we see here. There's the high. And then all of these short-term highs, they're all potential raids on liquidity. It doesn't matter if the market's going to go higher or lower on the day. It's likely to draw to them. Okay, so the daily bullish fair value gap, remember I had it in yellow on the daily chart? This is what we're seeing it drop down in here. I noticed because it could draw up to here, but I wasn't going to be able to be in front of the charts that long. I noticed that we dropped down below relative equal lows here, and we had another short-term low here. And we did that right at 9:30. So we opened, traded down, took out that liquidity, took out that liquidity, and that liquidity in the scope of that time. At 9:30, this candlestick here, I knew that we would likely draw up and at least clear these relative equal highs, and then maybe take this one out, but ultimately trade back down here, which is a move I would not be able to participate in because I'm away from the charts. So to teach also for the folks that are leaving comments in my video channel or my YouTube channel's comment section, asking, well, you can't trade without these macros, or you're not able to trade without the new week opening gap and new day opening gap. So if you take that away, then everything falls apart. Well, I'm going to show you that that's not true. Okay, so the executions you're going to see here are not based on new week opening gap, new day opening gap, just pure liquidity and time of day. Okay, that's all it is. So it's not a matter of me forcing you all to trade, one method or one apparatus that I've presented as my concepts that are not generic. It's funny how these goobers have all these comments, but it's this precision. Okay, precision. You're going to see it. But trading below here, we have the liquidity taken multiple times. Let's take a look at this presentation of entry here and running to this very easy low-hanging fruit objective. Okay, I don't need it to go all the way back to here. I don't need to go to here. I don't need to go all the way back to the 7 o'clock reset on the liquidity for that pre-market session hour. So 7 o'clock in the morning to 9:30, that 90-minute window, we're spanning from the 9:30 opening bell back to 7 o'clock. Where is the pools of liquidity? If you target those, you don't need anything else in ICT's repertoire. You don't need anything else. You don't need new week opening gaps. You don't need new day opening gaps. You don't need any of this stuff except for just knowing where price is at right now and where it's likely to draw to. If you have an opening range gap, which in this case was a gap lower, so that means it's likely to do what initially? Try to make an attempt to move up into that gap. I'm not going to show you the relative. I'm not going to show you the regular trading hours to show that gap. You can do that on your own, but it's likely to do what at the opening bell? Open here and then draw up. Now, does it need to fill the gap entirely? No. Does it need to go to the lower quadrant? No. Does it need to go to consequent encouragement? No. But an attempt at all is, within the realm of reasonable. So if it's going to make an attempt to do that, doesn't it make sense inside the scope of 9:30 to 7 o'clock in the morning? Where is the easiest low-hanging fruit first presentation of relative equal highs? Right there. Okay. Now I'm going to hover over top of both of these arrows so you can see the execution placement. So here's the liquidity. After taking this larger pool of sell side, there, and there at the opening bell. So I'm watching this candle. It opens, trades below these two equal lows. And as soon as it trades back up into this area here, I know what it's doing. It's going to flip over and run at the very minimum here. Now, at worst, it could have went just above here and then came back in and filled in or gave an institutional order flow entry drill on any fair value gap from that low up to that point. But here it just rips higher, uses it as a breaker here, leaves that little portion open, breakaway gap, runs up and gives me the run into the relative equal highs. Trades just above this high here, which are relative equal highs as well. Now, why did I pick this one and not that one? Because this is the first one you come to at opening bell at 9:30 opening. Start looking to the left. Where's the first relative equal highs? They pop off right here. If you're looking at a 15-second chart, it would be here. But that's not enough for me to take the trade. It's not enough of a reward for the risk. Because I could have been wrong. I could have got stopped out and you would have saw it. I would have showed it. But the stop goes immediately right below this by 1 tick. So buying, stop here, target here. There's a little entry caret symbol that shows you where my entry was on this candlestick. And now I'm going to hover over top of this one here. And you'll see that it shows me exiting the long trade here at that level there. And it spends a little bit of time right there and then folds. It goes right down to that daily bullish fair value gap. It creates a low one more time to stop anybody out to try to chase that and then rallied up.
So looking at the chart, I don't see any setups for myself within the first 30 minutes. Yeah, I can see the stop hunts, but there's nothing really here that I personally would like to take. Now, after this run down, we do have a fair value gap here, but I would like to wait for confirmation. So we get that confirmation. Here, there's a very, very small fair value gap, but a fair value gap nonetheless. Now, I wasn't around to trade this day, but this is where I would have tried for a long with the stop here at the low. And then I will be aiming for, well, first partial would be this fair value gap here. And then I will take the trade off completely above this high. So in the last couple of videos, I emphasized on the core ICT principle of the market moving to liquidity. And that you only need to learn 2 PD arrays, one of them being highs and lows, because that's where liquidity is. Here, you heard it from ICT himself. If you target pools of liquidity, you don't need anything else.
Whenever there's a pool of liquidity that's taken, okay, and it forms with a breaker, as we see here, we have a low, high, and then it runs to take this low out here into a larger pool of liquidity. This point of liquidity below that low here, inside that daily bullish fair value gap, that is where this leg of the breaker, if you look inside this leg, you'll see a fair value gap. Now, this fair value gap here, you want to start looking, going back. Where's the first one you come to? It's this one right here. You got to use the volume imbalance. This specific fair value gap is labeled by my PD arrays as the gauntlet. Okay, it's a gauntlet. That means you're laying down the gauntlet. I'm going to go long on the belief that this low has taken out sufficient liquidity, and then it should go higher to reach into this level here where there would be a breaker. You can use that as a breaker entry. There's lots of times where I use this as a mechanism for turtle soup. You'll never see this methodology explained in Linda Rasch and Larry Connor's book. And no other goober that's claiming to be the author of Turtle Soup ever done anything like this either. Oh, these goobers. So what we're going to do is we're going to highlight that right there. Okay, so this is the gauntlet. It's a very specific fair value gap inside of a price run of a bullish breaker. So it's the very lowest first sell side imbalance, buy side inefficiency. It has to be the SIBI. Okay, so when it's bullish, and you reverse this when it's a bearish breaker. It's the price leg that runs to the liquidity. The very first, going from the low back, that's the very first SIBI you come to. This is what you're looking for. When it rates above it and it comes back down in, there's your entry. This is your adding to it. I promise you, someone's going to rush to get this in print, and so I'm going to leave some of the details out. But trust me, this is the gauntlet. This is one very specific fair value gap that is pertinent to how you can engage price action and using the levels here. After it leaves the lower half, see what it does? Trades to it here. The body's staying above it, and then gives you one more time to add to it or enter if you missed it back here. If you did not utilize this, for the folks that say my silver bullet doesn't work anymore, I want you to think about how this drop down in here, isn't that part of the upper quadrant, or the upper half rather? Isn't this right here, this whole mechanism of using a SIBI going into inversion fair value gap, that's what this is. That's a silver bullet. But I'm highlighting these quadrant levels here, and now I want you to look at this price level right up here. Okay, we're going to show you who knows what, and we're going to also show you what the signature is with the algorithm. If I highlight and hover over top of this very candle right here, which is what I'm doing, I'm screenshotting it, where it's me hovering over the 7 minutes after 10 candle on the 1 minute chart. That low comes in at 19,784.25. That's what's being highlighted here. The upper quadrant of this very specific, with the volume imbalance, that upper quadrant comes in at 19,074.25. Boom. That's perfect, folks. Linda Rash can't teach that. Larry Connors couldn't teach it. Wyckoff didn't know anything about it. Supply and demand? Nope. Elliott Wave? Nope. Sorry. No pitchforks here. Sorry. But that's perfect. That's an algorithmic price delivery signature, proving to you that the buying and selling pressure did not just agree to stop right there and agree and say that's the lowest this candle's going to go, and it's going to go higher from there. It takes more faith to believe in that than it is that the market's rigged and it's controlled and it's going to a very specific level, stopping and turning on a dime, going higher. Why did they want to go down below this low? Why didn't they want to go down to the midpoint of it again? Why didn't it just roll over entirely? Because it's scripted. It's also occurring during a very specific time of day. I'm going to go in closer and zoom in on this, but I want to show you here is the buy side imbalance, sell side inefficiency. So here is your silver bullet. Forget the gauntlet. Forget that, okay, for now. But there's going to be people putting them in their YouTube videos now. That's good. It's good. It's good. The buy side imbalance, sell side inefficiency here, that's your silver bullet. And this is institutional order flow entry drill right there. And that price running higher tells you that we're moving higher. But this candlestick right here, what I did with Thursday of last week's daily premium wick, we're going to do the same thing right here. We're going to look at this wick here. Let me zoom in. Here's that wick right here. Okay. And we're going to take the levels of the high, the up quadrant, consequent encroachment, lower quadrant, and the low, which is the close of the candlestick right there. And we're going to project them forward.
Okay, so we got a new fair value gap, the ICT Gauntlet. But again, you don't really need all these entry mechanisms. The important thing is to understand liquidity. We took out sell side with this drop down, then we dropped down one more time at 10 o'clock, and then you can get in with a whole bunch of stuff. But choose just one, just to keep it simple and consistent. I like this confirmation fair value gap. It just so happens to overlap with the Gauntlet fair value gap, but you also have this fair value gap. This is also a small little breaker that you could use to enter into. And then you can go long with this change in the state of delivery as well. And I'm sure he's going to talk about this wick, but you can see that there are so many things you can use, but just stick with one so you don't overload yourself with too much to think about. Keep it simple, stupid.
So if you take those levels and project them forward, you can see those specific levels here. And now we're going to, inside this range from this candlestick's close to this candlestick's run higher, I'm going to take you down into a 15-second chart. Okay, inside this little range here, this is all you need. When you know you're on side, that means the market's done enough down here during the macro. So at 9:50 to 10:10, that's what this is delineating here. Market drips down into the daily bullish fair value gap. Remember that yellow area on the daily chart I started with? Then it rips higher. We have a shift in market structure here. Silver bullet, institutional order flow entry drill. Then we have this wick in here. We have the gauntlet. We have the turtle soup, low to low. Okay, you shift in market structure. We have this wick's consequent encroachment. Bam. See how all these details are like, converging. It's a confluence of multiple factors suggesting that it's done and it's going to go higher. So let's look inside this little range here on a 15-second chart. This is that 15-second area in here. Okay. And before I go into detail here, I want to show you what I was seeing on the 15-second chart. Because as I mentioned, every time I talk about executions, I'm looking at a 15-second chart, folks. Okay. Just because you don't see it doesn't mean I'm not looking at it. If you look over here, when that dropped down at 9:30's candle, I'm entering right inside that. So as it reclaimed bullish fair value gap, relative equal lows, it just stabbed below that. And then when we're here, I'm going long while we're inside that. And the stop loss can be right below there. And this right here, this wick, you can break that down in the quadrants, and stop loss has to be at least below the low. And it comes down to about the lower quadrant, and then rips higher and goes to my target up here, as I mentioned when we were on the 1-minute chart. But over here on the 15-second chart, you can see that that range has fair value gap and volume imbalance. The market trades up, the bodies are staying inside that range, and then drops down, the bodies stay inside the lower quadrant, wicks down into the volume imbalance, but the bodies are staying inside of that buy sign imbalance, sell sign inefficiency. And then it rips higher for this pool of liquidity right there. Remember I told you, start looking at the 15-second chart, find the relative equal highs and lows and what time they run to them. Okay, the price run begins inside the macro time to here. All this looks crazy now, doesn't it? It's a 15-second chart. And look how clean the price action is. It didn't look that clean so much on the 1-minute chart. But when you know the bias and you know the narrative, how it's going to employ the daily range at certain points of turns at time, everything becomes much more clear. And that's this area over here. And in the afternoon, I did a 1-for-1 risk. Took some of the profit that was over here, risked it here, and then added to it here for sell side there. And there you go. So with the positions from Monday morning, Monday afternoon, and then Tuesday's morning and Tuesday's afternoon, it's 103,000. Notice how we ran up into the first percent of fair value gap on Monday. Wild, isn't it? And now, grubbing on over here. Wednesday's constant encouragement of the wick, lower quadrant, low. We trade down into it. Look at this crazy price run, right up to Thursday's high. Thursday's premium wick high. This is the low of the wick, lower quadrant of it, constant encouragement of it, upper quadrant of it, and the high of it. So they've worked a lot of the upper half. They dip down below it here, right back up in the Monday's or the week's first percent of fair value gap here, and then we broke lower. So with FOMC later today, it's basically you want to stay away from it. Okay, let's say it that way. Longer term, I think we could potentially trade higher. I'm not trying to pick a top. I'm looking for them to try to squeeze on those individuals that have been propped on the downside. So FOMC would be a wonderful medium to do that with. Even if it was just to go up there, make a higher high on the daily chart, and that what we've done in recent days, just to go lower. So either or, it's likely to go up, and up to what? You can take out this here. These are relative equal highs. There's a lot of buy side up here.
Okay, so that's it for this lecture. We got a new fair value gap, just a little intro, but as I've been saying in the past few videos, you don't need to be learning any of the new stuff. It's worthless if you don't have a strong foundation, which is the draw on liquidity. You need to be able to know where price wants to go, and then you can use practically any entry technique, whichever is most comfortable to you. So if you enjoyed my commentary, please like on the video and subscribe for more videos like this, or check out my last one where I gave a top-down analysis on gold. But until I see you next time, safe trading.